Tyler Jayroe, Portfolio Manager at JP Morgan Asset Management in New York. First of all, Tyler, thank you for making the trip out to participate in the Inside Networks Alternative Symposium.
Thanks for having me.
It's a great pleasure. Tyler, 85% of companies are private, yet most private wealth portfolios remain very heavily public market focused. What are these investors missing by overlooking private markets?
You know, it's interesting, actually, when I learned that I was going to be coming to Australia, I talked to a friend of mine, and he was really jealous. He said, he's really into looking at all sorts of different aquatic creatures, and this is one of his bucket list trips. And he actually mentioned to me that there are marine biologists who estimate that about 90% of deep sea species remain undiscovered to this day, which is kind of how I feel about private markets, right? There's, if you think about it, over 85% of companies with revenues over 100 million in the U.S. are privately held. And within that 15% that are public, there's been a growing consolidation in a relatively small number of large mega cap companies that are trading at historically high valuations. So with private market exposure, you really get access to diversification and what we feel like is return enhancement. Over long periods of time, private equity is typically outperformed with public markets with lower volatility. So we really believe that's an exciting time to invest now in private markets.
One of the major exit routes for private equity investors is the IPO market, which has been fairly constrained. Are there any triggers that you see that could drive an uptick in IPOs and something of a renaissance for listed assets? Or do you foresee a trajectory where private ownership and companies opting to stay private and stay private for longer just continues as a trend?
Yeah, I think that trend is going to continue. There are really a few reasons to go public, and a couple of which really, are solved essentially in the private markets. It's really not as difficult to raise capital if you're a fast-growing company with, promising, technology or market. It's also easier to provide liquidity to existing investors through private equity secondary sales. I wouldn't forecast a real growth in IPO markets. For us, that actually is really not going to impact our ability to generate liquidity for our investors, because approximately 2% of exits for small and mid-market buyout investments where we focus are through IPOs. It's really almost all sales to strategic investors or to larger private equity firms.
Your team plays across the spectrum. It targets primaries, secondaries, co-investments. How do these strategies differ, and where do you see the most compelling opportunities in today's market?
We really love having the flexibility to invest across secondaries, co-investments, and primary investments. That gives us the opportunity to really scour the universe. We see over 1,000 deals a year and really only invest in what we feel like are the best risk-adjusted opportunities that we see. The secondary market is quite interesting right now because we're seeing a number of limited partners who are over-allocated to the asset class. They've not been getting the liquidity that they've become accustomed to because there's been really a dearth of exits in the private equity market. So we're able to provide that liquidity as secondary investors. So that's a really compelling opportunity, especially leveraging our primary capabilities and our access to over 250 general partner relationships. And co-investments have become a really interesting part of our platform over many years, really providing attractive mid-market buyout exposure with generally no fees or carried interest layer charged by sponsors. We're getting to the ability to really cherry pick some of the best opportunities that we see across the market.
It's an increasingly competitive market in private equity. Many funds focus on large, high-profile deals. Your team likes to focus on small and mid-cap companies. How does that impact returns, or does it in any way?
It's really interesting. Over the past 10 years, we've seen a real growth in the consolidation of capital at the larger end of the market. So in 2015, I believe around 16% of capital raised in the buyout world was allocated to funds raising $5 billion or more. And last year, that was over 55%, so more than tripled. Really why we think that's a net positive for our strategy is we focus on small and mid-market funds and companies that are really capitalizing on a lot of the trends that we see in the least efficient end of the market, where we can help these oftentimes founder or family-owned businesses grow, professionalize, do add-on acquisitions, and create value for investors.
Tyler, the event closes with a workshop that's going to explore the institutional approach to alternatives. A lot of advisors in the wealth space have read a lot about this, and they've watched the institutions putt, and they want to replicate that approach and the allocations and just generally hopefully go where the institutions have gone before them. So what guidance would you have for advisors who are seeking to replicate the allocations and the approach that the investors like the big super funds in the Australian context have taken before them?
I think it's an excellent question. It's a really exciting time to be investing. If you really have not had exposure to alternative investments and specifically to private equity, which has been a source of alpha for institutional investors for decades. One of the reasons we're really excited about bringing the private markets fund to Australia and around the world is this ability to apply the same process, the same strategy, and create the same type of portfolios we've been cultivating for our institutional clients over 4 decades at JP Morgan. And if I were to be an advisor allocating to private markets as a first time, obviously you want to consider the potential sources of capital for these strategies. These are long-term oriented. You need to be comfortable with liquidity profiles, but really having exposure to the same types of investments that have been generating really strong outperformance for institutions for so long is quite compelling.
Tyler Jayroe from JP Morgan Asset Management, it's a great pleasure hosting you here in Australia. Thank you for your time.
Thank you so much.